Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at ServiceNow.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
All right, so imagine you're building the central nervous system for the entire global economy. Like you are processing billions of transactions, you're printing cash, absolutely crushing Wall Street's estimates, right? And then, you wake up one morning to find the market has just mercilessly sliced your valuation in half.
Yeah, it's brutal.
It is. And that is exactly the situation we are unpacking today for you. We are looking at an absolute software giant that has suffered a, frankly, brutal 50 to 60% drawdown. I mean, shares plummeted from a 52-week high of $211.48, collapsing all the way down to the $102 level.
Which is just a massive washout.
Exactly. And if you were holding this stock or, just watching from the sidelines, your natural instinct is probably skepticism because the market rarely cuts an industry leader in half without, a really compelling reason.
Right. And that extreme skepticism, that is exactly where we need to start this deep dive. Because when a dominant best-in-class platform experiences a washout of this magnitude, there are really only two possibilities.
Okay, what are they?
Well, either the underlying business model is fundamentally broken and the market is, correctly pricing in its demise, or institutional panic has created a severe mispricing.
And in this case, the fear driving a sell-off is this whole narrative that artificial intelligence is going to permanently disrupt their core business.
Exactly. So our goal today is to look at the actual mechanics behind their operations and figure out if this is a permanent repricing or a genuinely rare asymmetric entry point.
Let's move into the wealth building context because, if you are trying to decide whether this beaten down stock deserves a place in a long-term portfolio, you can't just look at the share price. You really have to understand the product's actual grip on its customers.
Yeah, the stickiness.
Right, and that comes down to their competitive moat, which they call a system of action.
Yeah, and that phrase is crucial because it differentiates them from most enterprise software out there. Historically, a lot of software just acts as a system of record.
Like a database.
Exactly. Think of a standard database or a digital filing cabinet just sits there holding information. The system of action, on the other hand, is the engine that actively executes tasks across an entire company.
Wow.
Yeah, ServiceNow currently processes over 100 billion workflows a year.
Wait, 100 billion?
100 billion. That spans across 7 trillion individual transactions. And that sheer volume of execution is growing at 25% year over year.
That is insane scale.
Yeah.
Think of it like the nervous system in a human body. If you run a massive enterprise, you have all these distinct isolated organs, right? You have your HR department using one software, your IT department on another.
Customer service on something else entirely, yeah.
Exactly. ServiceNow is the literal neural network wiring all of those isolated organs together so they can actually communicate and execute complex tasks automatically. And this is the key for long-term investors. They have spent 22 years building a proprietary library of workflow data, and it's all embedded inside their context engine.
Which is the foundation of their entire moat. A new competitor cannot just spin up some cloud servers, write a sleek user interface, and replicate 22 years of highly specific enterprise-level workflow data.
It's impossible.
Right. And going back to your nervous system analogy, it really highlights why their retention is so incredibly high. Because once a company wires this platform into their daily operations, removing it becomes a massive surgical procedure.
Oh, totally. If you want to rip it out, you aren't just canceling a software license, you are severing the communication lines between your HR, your IT, and finance departments.
It's chaos.
Absolute chaos. It requires retraining thousands of employees, breaking countless custom API connections and risking catastrophic operational downtime, which is, frankly, a terrifying prospect for any chief information officer.
Which is precisely why ServiceNow boasts a massive 97% gross retention rate.
97%. That's incredible.
Yeah, even when corporate budgets tighten or, when clients complain about pricing renewals, they simply do not leave. That retention rate establishes a rock-solid floor.
Right.
When you invest here, you aren't gambling on whether they can find a whole new crop of customers next year. You are buying into a compounding, highly predictable cash flow machine.
Now, let's look at the fundamentals. Because we have established the theoretical strength of their nervous system, but we need to see if that strength is actually translating into hard revenue.
Right.
Especially in a macro environment where tech budgets are supposedly shrinking.
Hmm.
How do the actual numbers contrast with this disastrous 50% stock drop?
Well, the divergence between the stock's performance and the underlying business performance is staggering. Let's break down the data from the first quarter of 2026. Total revenue hit $3.7 billion.
Okay.
That is a 22.1% increase, which comprehensively crushed Wall Street's expectations. Subscription revenue specifically grew 22% to $3.67 billion.
Oh.
And when you look at the bottom line, earnings per share came in at 97 cents, absolutely demolishing the consensus estimate of 80 cents.
Okay, let me pause you there. Because the math feels entirely disconnected from the narrative. I mean, the market cut the stock in half because of the fear that AI is destroying their business, yet they're growing revenue at over 22% and beating earnings targets by a massive margin. Are their customers actually abandoning them for AI startups?
Not at all. In fact, they are monetizing AI faster than almost anyone else in the enterprise software sector.
Wait, really?
Yeah. They recently rebranded their core AI assistant as Otto, and that product alone just reached a $750 million annual contract value.
$750 million just for the AI assistant.
Just for Otto. And this isn't just experimental spending by their clients either. The number of enterprise customers signing contracts worth over $1 million, specifically for ServiceNow's AI products, grew by over 130% year over year.
Okay, so the market is terrified of AI disruption, while ServiceNow's actual enterprise clients are willingly writing million-dollar checks for the exact AI tools the market thinks will kill them.
Exactly.
That is a massive disconnect. But what about the forward-looking metrics? I mean, could it be that Q1 was just a fluke and management is forecasting a cliff?
Actually, management's forecast signals the exact opposite. They raised their full-year 2026 subscription revenue guidance to a range between $15.735 and $15.75 billion.
Okay, so they're confident.
Highly confident. Furthermore, looking long-term, they are targeting over $30 billion in subscription revenue by 2030. To hit that, they need an 18.5% compound annual growth rate, which, their current performance proves they are more than capable of sustaining.
Let's talk about the balance sheet for a second.
Okay.
Because setting a $30 billion target is great, but navigating the volatility of the next 4 years requires serious financial armor. Are they carrying enough cash to weather a potential macro recession?
Their balance sheet is an absolute fortress. In 2025 alone, they generated $4.6 billion in free cash flow.
Wow.
Yeah. They maintain an incredibly healthy gross margin of 81%. And arguably the most important metric for a subscription business, their remaining performance obligations, which is essentially contracted revenue that they just haven't recognized on the books yet, that currently sits at a staggering $27.7 billion.
See, I love seeing an 81% gross margin, but I have to push back on a specific maneuver management just pulled.
The debt raise?
Yes, the debt raise. They recently executed a $4 billion debt raise, and they used that debt to authorize a $4.2 billion share buyback right as the stock hit these massive valuation lows. So they effectively took out a massive corporate mortgage just to buy their own stock at the bottom.
Right.
Some analysts would look at that and say it's just financial engineering designed to artificially prop up a falling share price.
I completely understand why that looks defensive on the surface, but when you break down the math evaluation, this is actually a masterclass in aggressive capital allocation.
How so?
Well, right now, the stock is trading at a roughly 16 times free cash flow multiple, which is a decade-low valuation for this company. What they are doing is systematically extracting float. By taking on relatively cheap debt to buy back undervalued shares, they're pulling millions of shares off the open market and retiring them.
So making the remaining slices of the pie bigger.
Exactly. That mathematically increases the ownership percentage and the future earnings per share for every investor who holds onto the stock. They are heavily capitalizing on the market's irrational panic.
That brings us to the catalyst timeline. Because analyzing the fundamentals and the balance sheet, well, that only tells us what the company's done in the past. If you were looking at this 50% discount and wondering when the market is actually going to wake up and reprice the stock, you need specific events on the horizon to force that change.
The most immediate event forcing the market's hand will be their second quarter earnings report, scheduled for July 22nd, 2026.
Okay, coming up.
Right. Right now, consensus models are projecting 76 cents for earnings per share. However, considering the massive outperformance we just walked through in Q1, there is a very high probability of positive upward revisions as we get closer to that date. The crucial metric you want to monitor in that report is constant currency subscription growth.
Just to clarify for the listener, constant currency growth means we strip out the noise of fluctuating global exchange rates to see how the actual underlying sales are performing. Right.
Exactly. We need to see that constant currency growth stabilize at 18% or higher. We also need to see the remaining performance obligations continue growing at 21% or better.
And if they do?
If they hit those numbers, it mathematically dismantles the bear thesis that their growth is stalling. But beyond earnings, there is a major structural catalyst involving their recent mergers and acquisitions.
Oh, right. The chatter around their recent massive acquisitions of the cybersecurity firms Armis and Veza.
This is a critical development. ServiceNow's entire architectural advantage relies on a single data model. Unlike other legacy software companies that buy up random startups and clumsily stitch them together with fragile code, ServiceNow builds everything on one unified framework.
Which is much cleaner.
Exactly. And there are intense market rumors right now that the integration of Armis and Veza into this single data model is happening significantly faster than Wall Street anticipated.
And why does that matter so much to the share price?
Because if they can natively integrate those tools, they can instantly cross-sell advanced cybersecurity capabilities to their massive existing customer base without requiring complex installations. It prematurely unlocks the massive cybersecurity total addressable market.
Which is huge.
Huge. It brings billions in potential new revenue that analysts have absolutely not priced into the current stock valuation.
But let me throw a wrench into that optimism.
Yeah.
What if the broader macroeconomic environment simply refuses to cooperate?
Yeah.
I mean, right now, institutional mutual funds are aggressively avoiding battered software stocks. They are rotating capital entirely out of this sector.
That's true.
So even if ServiceNow posts an incredible Q2 earnings beat and integrates those acquisitions flawlessly, can a single company's performance overcome the gravity of a market that just hates software right now?
It is incredibly difficult to fight a prevailing market trend, I'll give you that. But you have to understand the mechanics of mean reversion. When institutional sentiment becomes this universally negative and massive funds are deeply underallocated in a sector, the market becomes a coiled spring.
Ready to snap back.
Exactly. Any slight shift in the macro environment, say a softer than expected inflation print or a stabilization in interest rates, can trigger violent short covering. When institutional managers realize they are missing out on a company growing free cash flow by 34% at a massive discount, the rotation back into the stock can be explosive.
Now let's pivot to the chart. We need to connect these fundamental catalysts to how the stock is physically trading day to day. You mentioned this institutional washout. How is that reflecting on the technical structure?
Well, the technical setup right now is actually quite compelling. Following the initial post-earnings panic that drove the price down, the stock did not continue to bleed. Instead, it has actively started carving out higher lows.
Forming base.
Yes. Systematically forming a solid foundational base right around the $102 level. We are currently tracking breakout potential originating from those April 2026 lows. In fact, specific technical chart patterns suggest there is a 34% upside potential just to reach the next major technical resistance zone at $136.
We did see a glimpse of that upward pressure recently, right?
Mm-hmm.
I mean, the massive Q1 earnings beat acted as a catalyst for an immediate 11% weekly advance.
Right.
But if we're being completely objective with our chart analysis, an 11% bounce following a 50% collapse is technically just a relief rally within a broader downtrend. For full, undeniable confirmation that the macro trend has actually reversed, there is a very strict mechanical condition that must be met.
The golden cross.
Exactly. The 50-day moving average must cross back above the 200-day moving average, which is that pattern known as a golden cross. And it has to happen on significant institutional level buying volume. Until we see that definitive golden cross, the stock is technically still proving itself.
And that is a very necessary dose of technical discipline. However, this is where fundamental engineering directly supports the technical chart. We cannot ignore the impact of that $4.2 billion share buyback program.
Oh, that's a good point.
Yeah, that buyback acts as a massive systematic bid underneath the stock. Every single day, the company itself is stepping into the open market and absorbing the sell pressure. That constant underlying bid acts as a vital shock absorber against broader market volatility, helping construct the exact technical base required for those moving averages to eventually curl upward and form the golden cross.
So what does market sentiment look like right now? Because we have this incredibly washed-out technical chart, we have institutional funds avoiding the sector, but we also have Wall Street analysts who seem bizarrely optimistic despite the price action.
It is a textbook divergence. The broader macroeconomic sentiment is undeniably bearish, fueled entirely by the fear that AI will render traditional workflow software obsolete. Capital is rotating out of the sector. Yet, if you isolate company-specific sentiment for ServiceNow, the professional analysts are overwhelmingly bullish.
Exactly.
Yeah. Bank of America, for example, just reaffirmed a firm buy rating. They assigned a $130 price target and specifically dubbed ServiceNow an agentic AI leader.
Hold on. We need to clarify what agentic AI actually means because it's distinct from just a standard chatbot, right?
Exactly. A standard AI chatbot just answers questions or generates text. You ask it something, it types back. Agentic AI refers to autonomous agents that can actually execute multi-step actions on their own.
Like what?
Like resetting a server, provisioning software for a new employee, or resolving a security ticket completely without human intervention. The fact that major banks are recognizing them as a leader in this specific high-value AI category is huge.
It is.
If you look at the broader consensus across 43 different Wall Street analysts, the average price target sits at $141.85. That target implies a massive 39% upside from the current trading levels.
And ServiceNow's management is aggressively pushing this narrative themselves. At their Massive Knowledge 2026 industry event, they prominently showcased their AI Control Tower framework. They're fighting back against the perception that they are an AI casualty and instead positioning themselves as the central orchestrator of the entire AI revolution.
Right, and they are securing strategic validation from the undisputed heavyweights of the tech industry to prove it. They just announced deep partnerships with NVIDIA on Project Arc, and incredibly, a massive interoperability partnership with Microsoft regarding Agent 365.
Wait, I have to stop you right there. They are partnering with Microsoft for interoperability. That sounds incredibly dangerous. Isn't Microsoft historically one of their absolute biggest competitive threats? I mean, inviting Microsoft into your ecosystem feels like handing the keys to the fox right in front of the henhouse.
Now let's talk about the risks, because
Yeah.
you just accurately identified the absolute core of the bear case against this stock.
Yeah, let's really dig into this Microsoft threat. Because if you look at the history of enterprise software, the most lethal event for a best-of-breed company is when Microsoft decides to build a good enough version of your product and bundle it into their existing software suite for free.
That is the exact mechanism of the threat. Microsoft essentially owns the identity and productivity layers of the corporate world through Azure and Microsoft 365. Every CFO is already writing a massive check to Microsoft every year. The strategic risk is that Microsoft aggressively bundles basic IT workflow automation into those existing E5 licenses at little to no extra cost.
Right. If you are a mid-sized company with a sub-$1 million IT budget, and Microsoft says, hey, you already paying for Office and Teams, here is a free workflow automation tool included, your CFO is going to demand you use the free tool.
Exactly.
Even if ServiceNow's nervous system is far superior for complex tasks, the good enough Microsoft product could severely cannibalize ServiceNow's market share at the lower end of the enterprise market.
That is a very real, persistent headwind. But there is an even more complex paradox hidden within the AI revolution itself. The ultimate bear case argues that these highly advanced AI agents are eventually going to replace the human workers that manage these workflows.
Which brings us to the AI seat cannibalization risk. This is the fascinating paradox at the heart of their business model. Historically, ServiceNow makes money by charging a license fee per seat. They charge based on the number of human IT professionals or HR representatives logging into the system.
Right.
But if a company uses ServiceNow's incredible new AI tools to automate those jobs, they fire the human workers. The human seat count drops, and ServiceNow's revenue theoretically drops with it. They are actively selling the exact AI tools that could eliminate the human licenses they charge for.
It is the defining tension surrounding the stock right now, and it explains a lot of the market's hesitation. But this is exactly where we have to look at the mechanical mitigation strategy management has deployed. ServiceNow saw this coming and has been aggressively pivoting their entire revenue model away from per-seat licenses toward consumption or token-based pricing.
How exactly does token-based pricing solve the paradox?
Think of it like a massive digital arcade. In the old model, you paid an entry fee for every human you brought into the arcade. If you brought fewer humans, the arcade lost money. In the token-based model, there is no entry fee. Instead, you buy digital tokens, and every time a game is played, or in this case, every time a complex workflow or API call is executed, a token is consumed.
Oh, that makes sense.
Yeah, currently 50% of their net new business is operating on this non-seat-based model.
That is a brilliant shift. They are essentially transforming from a digital landlord charging rent per employee into an AI toll booth. They get paid for the volume of traffic passing through the system completely, regardless of whether a human clicked the button or an autonomous AI agent executed the task.
Exactly. They get paid for the execution, not the employee. And this brings us to the most important question. How much of this cannibalization risk is already factored into the price? At a 16 times free cash flow multiple, following a 50% stock collapse, the market has already heavily priced in a scenario of severe, prolonged stagnation.
But the actual Q1 data, showing 22% growth, proves that stagnation simply isn't happening yet.
Precisely. The data completely contradicts the market's fear. However, you still have to monitor the metrics carefully. The absolute danger zone you must watch for in upcoming quarters is if their constant currency subscription growth suddenly decelerates from the current 18 to 19% range down to 16% or lower.
Because that would mean the story is changing.
Right. If we see that mechanical drop, it validates the bear thesis. It would signal that either Microsoft's bundling strategy is finally choking off their pipeline, or that AI seat cannibalization is outpacing the new token-based revenue. But until that deceleration actually appears in the hard data, the current market panic appears vastly overblown.
So with everything on the table, what's the final verdict?
Based on the underlying research, the bullish score here is a solid 8 out of 10. However, this is strictly a 2 to 3 year hold. To summarize the core thesis, we are looking at a remarkably rare asymmetric entry point for a dominant platform trading at a decade-low valuation multiple.
Yeah, that's hard to ignore.
The broader market is fundamentally mispricing ServiceNow as a casualty of the AI revolution. Yet, their massive 22% subscription growth and their Q1 earnings dominance prove they are not a casualty, they are the orchestrator. They are successfully building the ultimate AI toll booth. But this investment requires patience.
It's not going to happen overnight.
No. The re-rating is going to take significant time because a stubborn market will demand consecutive quarters of hard data to definitively prove that token-based pricing can fully offset any human seat cannibalization.
And as you review your long-term portfolio this week, just ask yourself this. If a company has successfully wired itself into the core operational nervous system of the global economy and is generating billions in free cash flow, how much of a temporary discount are you willing to demand before you finally step into the operating room? If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.